Hey everybody, hope everyone's doing well and had a good day. This is the Emini overview for Friday, August 30th, 2024. And overall, a pretty interesting day, and partly because it's the end of the week, it's the end of the month, and the price action itself was pretty interesting. So starting with the monthly chart, the market is in a tight bull channel within a more broad bull channel. And the question is, can the bulls get back to the channel line, or are we going up here before back down here? So if we think about what we have at this point on the monthly chart, a couple of different ways to look at it. Some traders will see 1, 2, 3 legs up. You can see we're also breaking out from this swing point. And the reality is, this was a tight bull channel. This trendline break, the expectation is sellers at the new high. And we broke out above this line, pulled back, and we're rallying. But look at the rally. A couple of decent bull bars, but only this one's breaking out, and then bad follow through. And then look at the month of August. We sold all the way down here, and then rallied and closed near the high of the bar. So for the bulls, 4 consecutive bull bodies, but this one closed below its midpoint, and this one has a huge tail. Also, you can argue late leg, so leg 1, pull back, leg 2, pull back, leg 3, and now we have a high 1 buy set up above August on the monthly chart. One of the problems with this high 1 buy is the size of the bar, and it's because of the trader's equation. If you think about it, if you're buying above the high 1, above the month of August on the monthly chart, stop below the bar, your target, your 1-to-1 target is all the way up here. And what are the odds that the market reaches the 1-to-1 target before it runs the stop? It may not be clearly 60%. And if that's the case, you cannot take the trade, because you need at least 60% for a positive trader's equation at 1-to-1 risk reward. So because of that, because we might be in a late leg, breaking out, it may be a possible higher high major trend reversal for the bears. And you have this high 1 late in the rally with a huge signal bar and bad trader's equation. The reality is there may be more sellers above this bar. They may not come in directly above the bar. Maybe the bulls get halfway to the target. Maybe we test 6,000. But the reality is we're probably not going up here before down here, at least with the information we have. On the weekly chart, we have this rally, 1, 2, 3 pushes, very deep pullback, and then a retest of the bull trend's extreme. So again, that major trend reversal setup. Yes, the rally was strong enough for a second leg, but it may have already been a late leg, maybe leg 2 or leg 3, maybe leg 1, pullback, leg 2, maybe 1, 2, 3. This was a significant trendline break, and the bears were able to get a bar completely below the moving average, and that's a sign of strength, plus a 4-bar micro channel. So the odds are, any retest, there will be disappointed bulls looking to sell out of their longs back up here, and you have trapped bears who missed the downside breakout, who are also looking to sell to catch a second leg down. So there's probably resistance not far above where we are. Also, this week was an outside bar. This week was outside last week. But the context, we're in a trading range. Big up, big down, big up, and now we have an outside bar. Outside bars, on a smaller time frame, they are expanding triangles. We had a breakout attempt below the bar, it failed, reversed up, and now we have a breakout attempt above the bar, but it's occurring high in a trading range, so probably limited upside and sellers above. And then the daily chart coming into the day, I'm actually going to switch over. This is the extended hours chart, and the point I want to make is better with the day only session. So here's what we have coming into the day. Big up, big down, big up. The market's in a trading range, and then the past 6 or 7 days have been in a very tight trading range. Yesterday, we had a bear reversal bar on the daily chart, and it's a low 2 sell signal bar. Low 1 below August 26th, and then low 2 below yesterday, the 29th. And the signal bar is decent. The problem is the context. So even though the signal bar is pretty good, bear reversal bar closing near its low, context will always trump a good signal bar. So if you ask yourself, what's the context? We have this really tight channel. In reality, it's actually a bull spike, and then a tight trading range. And the expectation, the bulls will probably get a second leg, but in any case, it's a tight trading range. We've had at least 10 bars above the moving average, and now we're getting a low 2 at the bottom of a trading range. There's probably buyers below yesterday's low. But again, because it's a trading range, if we do get above the high of yesterday, there's probably sellers above as well. So for the 5-minute, the blue lines, I have yesterday's high and yesterday's low drawn. And coming into the day, we have a gap up, and we can quickly take a look at the Globex chart to see what caused that gap up. Was it a strong bull trend? Was it a trading range? So here's what we have. Here's the information coming into the day. Here's yesterday's close. The market was in this weak bull channel. And bull channel means bear flag. So bull channel, yes. But the odds of getting an upside breakout of a bull channel is about 25%. More likely we'll get the downside breakout. And at this point, we may have a big leg one for the bears here, and then a prolonged pullback, and then maybe we'll get a second leg down. But at this point, the information we have is here's yesterday's close. Here's yesterday's close. The market was in this weak bull channel in the Globex overnight session, and that's why we're gapping up. But because of the sell-off at the end of yesterday, over here, this probably was not the second leg. This could all be part of the first leg, and then we may get a deeper pullback, but we'll get to that. So overall, gapping up coming into the day, and we're breaking out above a trading range down here. So the bulls are hoping we get a measured move of the breakout. And you can see it takes us to resistance from yesterday, near the top of the trading range. Makes sense. It's a reasonable target for the bulls. But at this point, we don't have much information. Bar 1's a good bull trend bar, but there is a tail on top, so there's some selling into the close, and that's not ideal. Plus, bar 1 remains the high or the low of the day only 20% of the time. And because of that, will probably trade above and below bar 1. So any rally we get on the open, even if it's strong, there's a 50% chance that it reverses. And especially in this context, big up, big down, big up, the market's in a trading range. And also, because the market's in a trading range, as strong as this bear breakout looks, it is a sell vacuum testing support. Now it should still get a second leg, but again, because it's in the trading range, we can get a deep pullback before we get that second leg. Bar 2, another bull bar, but more than half the bar is overlapping the prior bar. And then bar 3, breaking out to the upside, but pulling back and not closing above the prior bar. So we have a 3-bar micro channel on the open. But there's overlap, there's tails above the bars, the bull bodies are getting smaller. This is probably a wedge on a smaller time frame, and we can get a deep pullback before the bulls get a second leg. But bar 3 is a weak stop order sell signal bar. There are probably buyers below 3, buyers below 2, and buyers below 1. 80% of the time, the market has a trading range on the open. If this is going to be a bull trend from the open, the bulls have to do more than a weak channel. Strong bar on 4, but after the 3-bar micro channel, there's probably buyers below. But 4 is strong enough for a second leg. Bulls may step aside, set their limit orders lower, maybe look to buy below bar 1. And then an outside bar on bar 5. So look at the overlap on the first 5 bars of the day. All the bars are overlapping each other. For the bulls, it's a high 2, it's a double bottom with bar 1 and bar 5, but it's similar to what I was talking about on the monthly chart. Are the bulls going to buy this high 2 when 1 to 1 is all the way up here and there's this much overlap? Probably not. The bulls need more momentum. This is not a 60% trade. If you buy above bar 5, you're buying high in a trading range, and it's an expanding triangle. Inside bar on bar 6, the market's contracting. It's a triangle on a smaller time frame. It's an IOI pattern. So bar 4 is inside bar 5, and bar 6 is inside bar 5. It's a breakout mode pattern, but the market is mostly in a trading range. And if you consider yesterday's range, we're about in the middle of the range. So we are in no man's land. Traders look to buy low and sell high, but in the middle, it's the worst place to take a trade. And now we have a lot of overlap and a tight trading range. So in here, it's a tight trading range on the open. It's a limit order market. Probably sellers above 6. 7 broke out to the upside, but possibly 2 legs up. 1, 2. Might even be 3 legs, and it depends on how you look at it. We may be high in a bull channel. And remember, low probability that we get a bull breakout of a bull channel. Lots of overlap too. And then bar 8, we have a bear bar. It's a high 1, but bear signal bar, probably sellers above, probably going lower, probably high in this trading range. 9, another inside bar, sellers above, and it's okay to sell below bar 9, betting you're at the top of a trading range, but the signal bar isn't great. And if you're selling on a stop order, you're being forced to sell more towards the middle of the range, and that's not ideal. 10 fell below 9, but immediately pulled back. But now bar 10 is a weak high 2. It's a high 2 at the top of a tight trading range. Doji signal bar, consecutive dojis, probably sellers above bar 10, maybe even sellers on the close of bar 10. Then we sold off on bar 11. So we had a trading range on the open going up and down, back and forth. And then bar 17, we have a head and shoulders top for the bears. Left shoulder, head, right shoulder, and it's even nested. Maybe left shoulder here, head, and right shoulder. Then we have a bear bar closing on its low for the signal bar. But it's really not an ideal stop order trade. Bulls, they may be discouraged from buying below bar 17 because it's a bear trend bar closing near its low. But as far as selling here, you're selling low in this tight trading range. And all the bars have been mostly above the moving average today. The concern for the bulls here is that this bear breakout still needs a second leg, and this could all be a complex pullback before a second leg down. And at this point, we're just about at the midpoint of yesterday's range. So as far as whether we're going to yesterday's high or yesterday's low first, it might be 50-50 here, but because of the bear breakout, there may be a bias to the downside. And also the reason I'm pointing that out is because most bars are breakout bars, which means most bars break out above or below the prior bar's high or low, and markets are fractal, so that's true on all time frames. So that includes the daily chart. Good entry bar for the bears on 18, so consecutive bear bars, both of them closing on their low, one of them being big. It's always in short on 18, but so much trading range price action on the open that the downside may be limited. Maybe we'll go for a measured move of the opening range, maybe test yesterday's low, but remember what I said on the open, or coming into the day. The odds are there are buyers below yesterday's low. It's a weak low too at the bottom of a trading range on the daily chart. Bad follow through on the breakout after bar 18, but is 19 strong enough to reverse bars 17 and 18? Probably not. This breakout is strong enough that the odds are there are sellers above, and this should get a second leg down. And then the bulls, they don't get follow through, so bar 20 is disappointing for the bulls, probably sellers above, probably going to get a second leg down. You can see where bar 19 is testing. It's the bar 1 low, the bottom of this tight trading range. We got a breakout of the trading range. Bulls buy at the bottom of the trading range. They get trapped on bar 18 here. They scale in lower, and then 19 allows them to avoid a loss. And then 19 becomes a breakout pullback sell setup. Low 1 below bar 20. The signal bar is weak and it's an inside bar, but the context is better to sell than to buy. 21, you can call it a micro double bottom, but the bar has a bear body and it's following a pretty decent bear breakout that will probably get a second leg down. And then 22, the bulls are giving up. So the bulls, they tried to rally, bad follow through, and then a give up bar 22, probably going lower. A couple of targets below. We have the bear breakout and using the bodies of 17 and 18 down to here. And then there's the opening range measured move, both in a similar area. Momentum getting good for the bears. Tight bear channel. Still always in short and nothing to buy. Probably going lower. Okay to hold short. 24. Now a 5 or 6 bar bear micro channel. Probably sellers above. And then 25. A climactic bar testing the bar 17 and 18 bodies. That breakout measured move. 25, even though it's profit taking, it's not enough reason to buy. It's still a tight bear channel. 25 is a bad stop order buy, and it's still always in short. The concern for the bears here is we might be low in a trading range. You look to the left, there's support. The market rallied over here. It may be setting up some type of major trend reversal pattern where we have a bear trend, a trend line break, and then a retest of the lows. The expectation is buyers in this area, and that goes right along with the expectation that we had coming into the day with the daily chart. So yes, probably buyers below 25 and at yesterday's low, but this momentum is too strong to buy against. We want to see a trend line break first. The market starts to go sideways, a couple of legs, 27, pull back, 29, but now we have the first decent bull bar since 19. And what happened the last time we had a decent bull bar? Traders sold it. This is probably a minor reversal, and it's hardly a trend line break. So you can argue it's breaking the trend line, but there's not enough bars or enough distance for this to be a major reversal. So bad follow through on 30. For the bears, might be leg 1, pull back, leg 2, pull back, maybe one more leg down. At this point, it is more likely we're going to break out of yesterday's low than yesterday's high. Because of that, bulls may step aside, they may wait to buy lower. Bears, they might get aggressive, knowing that it's likely we get here, and that imbalance can lead to a sell vacuum. So a bear breakout on 31, but it pulled back. But the distance the bar fell below bar 30 was significant. And any trader who bought below bar 30 suffered this drawdown, and they may see bar 31 as a breakout pullback. 31, another good example of a bad trader's equation. So what about buying above 31? It's a double bottom, 25, 31. The bulls broke the bear trend line, so why not buy above 31? One problem is the bar is big, so your risk reward, you buy here, the reward is here, stop down here. But you have to ask yourself, is this a 60% trade? Are you 60% certain the market's going up here before down here? And I don't think you can answer that honestly, that it is 60% certain. Because of that, there's probably more traders selling above 31, the high 2, than buying above it. 32 rallied, but might be 1, 2, 3 pushes against the tight bear channel. It's a rally near the moving average and a decent bear leg, probably sellers above, sellers on the close. 33, now we have a low 3 set up, low 1, 27, low 2, 30, low 3, 33. For the bulls, if they're buying, 33 is a reasonable bar to get out of longs below, and bears can sell below 33. Even though the signal bar isn't great, the context is pretty good. Good entry bar for the bears, probably going lower, and now we have a breakout and follow through with a gap between the low of 33 and the high of 35. And then a give up bar, 36. The concern now for the bears, this may be leg 1, leg 2, leg 3, or simply leg 1, pullback, leg 2. So more follow through for the bears, good looking bear breakout, but occurring late. This is about 20 bars into a bear trend, and you have to ask yourself, is this a bear trend or is it a bear leg in a trading range? Even though we've been selling off since bar 17 in a bear channel, just look to the left, big down, big up, big down. Remember, this could be a major trend reversal pattern. There's a bear trend line, it was broken, we're retesting, and now we have a possible double bottom. The bears are hoping we break far below yesterday's low and fall for some sort of measured move. But at this point, we've only tested below the low, and we could not even close below the low. And then we tried again on 38, but reversed up. What about buying 38? Even though it's a decent bull signal bar, you're buying against 5 or 6 bar bear micro channel, and it's not ideal. The context is okay to start buying here and scaling in, but you need to use a wide stop, and this is strong enough for its own second leg. 39, now we have consecutive bull bars closing near their highs. 39 becomes a low 1 signal bar, but you're at the bottom of a trading range, and it might be a late leg, leg 2 or leg 3. So there's probably buyers below 39. The bears, once they get consecutive bars against them, low in a trading range, they may start to take profits, and more bulls may be convinced to buy. And now 3 consecutive bull bars. closing against the bears. This is strong enough for a second leg, and although it's only minor, the context is good for the bears, or for the bulls, that we're at the bottom of a trading range. And this looks like a bear leg in a trading range. And then a bull bar 41. Similar to bar 22, it's a give up bar. The bears, they see 3 bars closing against them, and then they give up. So bears start buying back shorts, bulls start buying aggressively. Now we have a 4 bar bull micro channel, probably buyers below, and this is probably going to get a second leg. This is a leg 1 breakout, and it's occurring at the bottom of a trading range in a possible major trend reversal. More follow through 42 closing above the moving average, going straight through the moving average. That's good for the bulls. Probably buyers below and going higher. I've got to speed it up just a little bit here. So more follow through 43, 6 bar bull micro channel with good bull bars, micro gaps. The first reversal down likely to be minor. And here's the first reversal attempt. Bear bar, but then a bull bar. Bear bar, but then a smaller bear bar. And the bull breakout was strong enough that there are probably buyers somewhere below, maybe 50%. You can see we came close to 50% on bar 47, but did not quite get there. 46, 47 strong enough for a second leg down, but 52 may have been that second leg. Leg 1, pullback, and then a minimum second leg. This looks more like a bull flag than a reversal attempt by the bears. It's a weak reversal attempt by the bears. This breakout is strong enough for a second leg, and we have not had that second leg yet. Now 54 could be that second leg after 46, 47. And then bad follow through for the bears. 55, now we have a double bottom, high 2. And after a strong bull breakout, 55 is a reasonable stop order buy. Good entry bar and good follow through for the bulls. Once we broke out above the last bull breakout's high, we did find selling. But do the bears want to sell after 6 consecutive bull bodies? Probably not. 60 is a weak double top setup. There's probably more buyers below. And we did not even get below. Traders bought the close and we're continuing to rally. I want to mention one more thing actually from back here. Because of the trading range open, again, you could call it a bear trend, but the reality is you look to the left, big down, big up, big down. It's probably a leg in a trading range. Whenever the market is sideways on the open, it's hinting toward the day type. When there's this much overlap on the open and you're in the middle of a trading range from the prior day, the odds of getting a trend day are low. The odds of this bear trend remaining a bear trend all day long was low probability. And that means the trading range on the open was a magnet. It was an area of agreement and will probably come back and test the midpoint of that range. And you can see the momentum for the bulls here. Strong leg 1, getting a second leg, and the second leg is also fairly strong. It's a tight bull channel, probably going higher. So the market continuing to rally. Is 65 a good sell? Of course not. We have maybe a 9 or 10 bar bull micro channel, and it is a reversal bar, but it has a bull body, and again, it's a micro channel. It's a spike. The odds are the first reversal will fail, buyers below. And then what about this? Is this a decent low too? No, it's a micro double top, but tight bull channel in an overall strong rally from the bottom of a trading range with room to the upside. Here's the midpoint of the opening range, trading range, and that is a magnet we'll probably get to. Another reversal attempt, but the bar could not close below the bars to the left, and even if it could, it would probably be bought. This is a strong rally and the bulls are buying any pullback. Bull bar closing on its high. For the bears, if they were selling, maybe they sold here or here. If the market goes against them one time, they'll sit through a pullback. But if it goes against them a second time, we get a high to buy, 70. The bears will give up and the bulls will buy aggressively. And then that's what we got on 71. 71, buy vacuum, testing the midpoint of the opening range, trading range. Another magnet, the high of that trading range. This looks like it's either a measuring gap or an exhaustive buy climax, an exhaustion gap. We don't know at this time, but we do know this is a tight bull channel with room to the upside of the range. So this might be a measuring gap. And then follow through 72. So we've already reached the first measuring gap, measured move. And then maybe here's the next one from the start of this bull leg to the breakout point of the measuring gap. The bulls are looking for this target. And you can see it's below yesterday's high. So the target is not unreasonable. Outside down, 73. But after a 4-bar micro channel, 3 consecutive bull bars, 72 is a weak low one. There's probably buyers below. It's an expanding triangle, and the bulls see it as a bull flag, a trend resumption setup. A big bear bar, but when's the last time a big bear bar had good follow through? It was all the way down here. 46 was a decent bear bar, pretty big outside bar, but bad follow through, and the market reversed. 54. Decent sized outside bear bar, but bad follow through, the market reversed. So the bulls will buy a bar like 73 and scale in lower, betting that we'll at least get a test of the high close of 72. And then you can see traders bought the close, probably going higher. The selling pressure through here is not very strong. 75, a low 2, a micro double top, but it's very similar to 67. It's not a good stop order sell. If anything, it's a trend resumption setup. The channel up is too tight. So any reversal pattern is better known as a continuation pattern. Traders can buy on limit orders below 75, buy the close of 75, or enter on a stop where the weak bears are getting their stops run above 75. And then a good bull bar, 76, and then the stops will run 77. 77 is testing the measuring gap, measured move. We're getting so close to yesterday's high, we'll probably get there. But if we do get there, there will probably be sellers above. 77 is the biggest bull bar in the entire rally. And now, if you look to the left, we're high in a trading range. So I think the risk here for the bulls is that 77 is an exhaustion gap. And 77 might be a profit maximizing bar, a bar that if you're long, you see that bar as a gift, you take your profits, and it can be really risky to buy a bar like 77. 78, the bulls got follow through, but the bar closed below its midpoint. It tested yesterday's high and then reversed down, probably going to go more sideways into the close. For stop orders today, through here on the open, really not ideal for stop orders. It's a limit order market, tight trading range. If you're buying or selling on stop orders, the market's typically forcing you to enter in the middle of the range, which is the worst place to enter. So for example, maybe you want to sell below bar 9, you're selling in the middle of the range. Maybe you buy above bar 12, but again, middle of the tight trading range. And then the same thing with 17, you're selling low in a tight trading range. 18, I thought you could sell below 18. Strong enough bear breakout for a second leg. First reversal, probably minor. Low one short below 20. You can sell. I typically don't prefer, let me back up. I prefer, if I'm entering on a stop order for a short, I prefer to sell below a bear bar, closing at least below its midpoint. So bars 20 and 21 are not ideal signal bars. And if you wait for 22, that's okay. It's a strong bar. You're entering at a worse price, but with higher probability. And then I thought 33 was a reasonable stop order sell, despite the weak signal bar. The context was good. Wedge bear flag, pull back to the moving average, with room to the downside. And then as far as buying 38, I think it's aggressive, but okay to do if you use a wide stop. 39, same thing. And 40, now you're getting 3 consecutive bull bars. Bulls can start buying, and then once you get 41, it's a give up bar. You can buy the close through here, always in long. Minor reversal, high 2 buy above 48, reasonable trade, and then a bigger high 2. So here it's a leg 1, pullback, leg 2. So high 1, 45, high 2, 48, but a bigger high 2 on 55, leg 1, pullback, leg 2. So 55, reasonable stop order trade. You can also buy above 56. Market's always in long with weak selling pressure, and you can buy anywhere along the way up. And whenever there's no reason to sell, it's okay to hold on to your long. And all through here, there's really no decent reason to sell. I thought you could buy above 70. It's another high 2, a place where bears will exit and bulls will buy aggressively. And then the same thing with 76 up here. High 1, 74, high 2, 76. So where do we go on Monday? Once again, the market has been in a tight trading range here on the daily chart for the past 7 or 8 days. It looks like an expanding triangle. And the risk of an upside breakout here is that it's simply testing high in a trading range. It's testing the bull channel line. And if you look to the left, there is room to the upside, but not a lot of room. So maybe we do get the bull breakout, but the upside might be limited. We're probably high in a trading range here. And it's a nested pattern. We're high in this smaller trading range, and we're high in the overall bigger trading range. So probably sellers not far above today's high. And also if you look at today, let me back up to the day only. You can see it's a decent looking bull reversal bar, but it's exactly the opposite of what I was saying about yesterday coming into the day. Decent bear reversal bar, but bad context. Same thing here. Decent looking signal bar, but it's an outside bar, and if you're buying high in a trading range. So it's a limit order market, and the odds are if bulls buy, they will be disappointed. There is a chance we get the upside breakout because this rally was so strong. This could be a pullback, then we get a second leg, but I still think the upside may be limited because of this big up and then big down. The bears did enough damage here, probably sellers at a new high. All right, thanks everybody for watching. Hope everyone has a good night.